spend a few moments just talking about the what and how that we invest in listed infrastructure. We're going to talk about performance. Certainly the last year has been challenging, so let's work through that. Some of the recent trends we're seeing in some interesting sectors, and why now might be a good time to consider listed infrastructure in your portfolios. So firstly, to step back, what are we investing in? These are listed companies around the world, typically a 40 stock portfolio. We'll have around half the fund invested in regulated utilities that are the ballast to the ship, and then around half the portfolio in more growth infrastructure. Think things like toll roads and airports in the transport space, but also LNG export terminals, wireless towers, data centers that give us a nice source of income and growth. These are assets that you use every day, so easy for you to understand because you're paying the bills on these assets each day. High barriers to entry, difficult to replicate, which is important for the sustainability of income and returns through time. We know that they provide a good source of income and it's regular, typically a 4% yield to investors. On top of that, what we can expect is growth that is more structural rather than cyclical. These are businesses that are typically regulated or contracted. Think of a water utility or a toll road, and they're investing for the long term, 5, 10, 15-year capital plans to build new infrastructure, and that structural growth that we see through time, we think is incredibly valuable for a total return in the long term. Because of the nature of the assets, they tend to be essential. We still use them during a recession. Because they're regulated or contracted, you may not get the exciting growth or up markets, but typically get more defense in down markets. So think of them as a defensive equity and a lower volatility solution through the cycle for your portfolio. We have a team of 10, all based in Sydney, Australia. As Paul mentioned earlier, as you go through time since 2007, we've had periods of luck, we've had periods of bad luck as well, but I'd hope that over that 17-year period, we've been able to show a good amount of skill and experience for you and a deep bench of investors to manage your portfolios through all types of market conditions. It's long-term performance, and really want to focus on the last 12 or 18 months. 2022 was a particularly strong year for infrastructure as the inflation benefits of the regulated contracted assets proved their worth and held up in a down market. 23, 24 so far has been more challenging with the rising interest rates, and we'll talk through that further. But over the long term, I think some good returns for investors through the cycle. So what's happened more recently, to focus in on, this is calendar 2023 in particular. The good news is that we did see a strong recovery from sectors impacted by the pandemic. So transport stocks that were impacted through 2020, 21 did bounce back. Things returned to normal. You would know yourself, congestion on roads is very much back to normal. Sorry about that. Airports are full again. Thanks for that holiday that you took to Spain. That was helpful for one of our stocks. But a good recovery there in the transport infrastructure space. Where things were more challenging is where there was particularly interest rate sensitivity, and things like wireless towers and utilities are more exposed to that rising rate environment, particularly now that inflation has settled down somewhat and you're looking at a rise in real interest rates, which is, if I think about the two biggest risks in this sector, a sharp rise in real interest rates and political regulatory interference are the two things we worry about in particular. And that's something that's definitely come through in the last 12 to 18 months. We feel from this point, some of those risks are now very much in the price, and we'll talk about some of the trends that we're seeing going forward. So the first sector I wanted to focus on was the utility space. This has been the most challenging over the last 12, 18 months in particular. There was some excitement in the utility sector back in 2022, particularly related to the US Inflation Reduction Act that provided significant support for the energy transition as we shift from coal to renewable energy. But the last 12 months, there has been a lot of news flow around that. There's been some concerns with the upcoming US election. Might that tip back the other way? I guess our view would be 2 points. Firstly, on the election, we still think 90% of the Inflation Reduction Act will stay in place even under a Trump administration. If you look at where the benefits of those tax credits are going for the energy transition, it's actually going into Republican states in the US. They're the key beneficiaries. The Midwest of the US, where there's a good wind resource, the southern states where there's a good solar resource, that will continue, we think, over the next 4 years plus, regardless of who's in power. The second point, and I think more important, is fundamentally we're seeing a real lift in demand and need for investment in utilities. One of the key underlying demand drivers is the big increase in electricity load or power demands that we're seeing across the space. Examples of that, the shift to electric vehicles, which is building over time. And more recently, the big increase in demand from data centers related to AI, artificial intelligence, and generally just the digital transformation that we're seeing in big parts of the economy. So we've seen a big increase in demand expectations over the next 10, 20, 30 years for electricity load. And regulators, politicians, our utilities are starting to get very nervous about the system not being able to cope with that increasing load, and therefore supporting more investment. Now that inflation has come down, cost of living pressures aren't as high as they were a year or two ago. There's more openness to accelerating that investment again. And in a regulated business, as you invest more capital, you grow the rate base of the business, and that automatically leads to a growth in earnings as well. And we've seen earnings lift by from sort of historic 4 or 5% growth rates for utilities up into 6, 7, even 8% range, not just for the next year or two, but we have a view out for the next 5, 10, 15 years because of this significant need for investment. So utilities a tough period, but coming into their own given these strong underlying fundamentals going forward. The other sector that was most challenged is the wireless towers sector. Now, this is a sector that historically has grown very strongly. It does tend to have higher levels of leverage and therefore a bit more interest rate sensitive. So we saw a few years ago when interest rates were very low, some quite high valuations on the wireless tower sector, as you can see on the chart on the left. So a mean reversion of that was a sensible outcome given the normalization in rates that we're seeing. And we've also seen that while growth long-term is structural, there are waves of growth, as you can see on the right. And you can think of that as 3G, 4G, 5G, in terms of the generation of capital investment in these wireless tower networks. And what we saw during COVID was a compression and acceleration of growth as everybody started to move to video conferencing and webinars and working from home. We saw a big increase in data usage and therefore the need to invest in the network, but that compressed the cycle such that we saw big growth a few years ago, but now the last year or so has been more subdued in its growth outlook. We think that growth will return, whether it's 6G, whether it's AI shifting from computations to usage, particularly mobility usage. That's where we will start to see a lift in growth outlook again. So we've been patient there with an underweight position, but have moved back into this sector to take advantage of the current valuations and the next wave in growth. Another sector we favour right now is the toll road sector. Inflation-linked pricing on toll roads, which we think will continue to be valuable going forward. Big investment in their networks during COVID, and I think the market underestimates how much capacity has been added, whether it's Australian toll roads or French toll roads or US express lanes. There's been 10, 20, 30% uplift in capacity of those networks, construction during the pandemic, that they will grow into in the coming years. And with governments loaded with a lot of debt, there's an opportunity there for the private sector, our companies, to provide more support to the government to resolve urban congestion. Bringing it back to home quickly in the UK, there's been a lot of headlines around UK water, some of the things that have gone wrong. I would highlight the listed companies are very good performers. Companies like Severn Trent, United Utilities are outperforming the regulators' expectations. We're coming into a period where the focus has shifted from keeping customer bills lower to a need to invest in networks. And I think companies like Severn Trent will benefit from that improved regulatory environment going forward. And right now, valuations are at interesting levels. And that's not just an outcome we see in the UK, but a shift in regulatory attitude around the world from customer bill to investment. Final point I'd like to make is just the why now, and that's around where some of the valuations sit today. We've had, as I mentioned, a little bit of a difficult period with the rising rates and a bit of political interference, the two big risks for the sector. That's now in the price. And when we look at valuations, particularly US utilities, we're seeing 30% discounts to the broader market. And if there is a pullback in the tech sector, if people start thinking a little bit more defensively across the market, we think there's a real valuation opportunity there today. And when we look at other sectors, whether it's railroads or energy or towers, we're seeing long-term fundamental valuation support that I think creates an opportunity for an overall portfolio. So hopefully that gives you a taste for Sentier Global Listed Infrastructure Fund. Certainly, if there's any questions following this call, our team would be more than happy to follow up with you. And I'm sure AJ Bell, who knows this fund inside out, is also there for you. So thank you very much for your time.